Uniform Customs and Practice for Documentary Credits, or in short UCPDC or UCP, ICC Publication Number 600 is a complete document of rules for documentary credits. Here all the articles are somewhat correlated and needs to study in collaboration. Welcome back. Today we are unpacking a really crucial part of the UCP 600, Article 12. It might sound a bit technical, but trust me, understanding this article is key to mastering letters of credit. We're going to break down what a nominated bank is and its roles and responsibilities. Let's get right into it. Before entering into the article, I will ask a favor of you to subscribe the channel. So let us dive deep. What exactly is Article 12 all about? It's titled Nomination. At its core, this article explains the roles and authority given to a bank, known as the nominated bank, by the issuing bank. Think of the issuing bank as the one who creates the letter of credit, or LC. They then nominate another bank to handle certain tasks, like paying the beneficiary, accepting a draft, or negotiating the documents. Let's break down the first part, Article 12A. It says, unless a nominated bank is the confirming bank, an authorization to honor or negotiate does not impose any obligation on that nominated bank to honor or negotiate, except when expressly agreed to by that nominated bank and so communicated to the beneficiary. This is a huge point. Just because a bank is named as the nominated bank in an LC, it doesn't mean they have to pay or negotiate. They have the choice. So if you're a beneficiary and you see a nominated bank listed, don't assume they are automatically on the hook to pay you. They are only obligated if they have separately added their confirmation to the LC, making them a confirming bank. Without that confirmation, they are acting as an agent for the issuing bank. They are essentially a post office, a place where you can present your documents. Let's imagine a scenario. A seller in Vietnam gets an LC from a buyer in Germany. The German bank, the issuing bank, nominates a bank in Vietnam to be the nominated bank. The seller prepares all their shipping documents and presents them to this Vietnamese bank. Now, if this Vietnamese bank has not confirmed the LC, they can look at the documents, and even if they are perfectly compliant, they can say, sorry, we choose not to negotiate or pay under this LC. They are completely within their rights according to Article 12A. They might do this for various reasons. Maybe they have credit line issues with the issuing bank, or they are concerned about the country risk of the issuing bank. Their nomination is simply an authorization, not a command. Now let's move on to Article 12B. This part is about reimbursement. It says, by nominating a bank to accept a draft or incur a deferred payment undertaking, an issuing bank authorizes that nominated bank to prepay or purchase a draft accepted or a deferred payment undertaking incurred by that nominated bank. In most cases, this is the issuing bank. But if a confirming bank nominated another bank, then the confirming bank is the one responsible for the reimbursement. Let's go back to our example. The nominated bank in Vietnam decides, okay, these documents are perfect, and we're confident in the German issuing bank. We'll go ahead and pay the Vietnamese seller. By doing so, they have honored the LC. Now they need to get their money back. Article 12B guarantees their right to claim reimbursement from the German issuing bank. The Vietnamese bank will forward the compliant documents to the German bank and expect to be paid. This is the fundamental mechanism that makes the whole system work. It ensures that nominated banks who act in good faith and follow the LC's instructions will not be left out of pocket. This also ties into the concept of a freely negotiable credit. If an LC says it's available with any bank, it means any bank in the world can act as the nominated bank. A seller can take their documents to their own bank or any bank willing to handle it. If that bank negotiates the documents and pays the seller, they are then entitled to reimbursement from the issuing bank. So Article 12b is the safety net for any bank that steps into the role of a nominated bank and performs its duty. But the nominated bank, who is not a confirming bank, must ensure that it has negotiated the compliant presentation only to claim its reimbursement. Finally, we have Article 12c. This part deals with a very specific situation. It talks receipt or examination and forwarding of documents by a nominated bank that is not a confirming bank does not make that nominated bank liable to honor or negotiate, nor does it constitute honor or negotiation. Let's say an LC requires the nominated bank to accept a draft that is payable in 90 days. This is called acceptance, and the nominated bank agreed to act under its nomination. Or it might require the bank to incur a deferred payment undertaking, which is a promise to pay at a future date without a draft. The nominated bank, that is not a confirming bank, may do this. Then they accept the draft or give their promise to pay in 90 days. But what happens if, before the maturity date, that nominated bank is no longer willing or able to pay? This could be due to bankruptcy or other issues. This situation also renders under sub-Article 12c. Then Article 7c is a crucial protection for the beneficiary. It says that an issuing bank undertakes to reimburse a nominated bank that has honored or negotiated a complying presentation and forwarded the documents to the issuing bank. Reimbursement for the amount of a complying presentation under a credit available by acceptance or deferred payment is due at maturity, whether or not the nominated bank prepaid or purchased before maturity. An issuing bank's undertaking to reimburse a nominated bank is independent of the issuing bank's undertaking to the beneficiary. Let's build on our example. The LC from the German bank says it's available by acceptance with the nominated bank in Vietnam, with drafts at 90 days after sight. The Vietnamese seller presents the documents. The Vietnamese bank finds them compliant and accepts the draft, stamping it and signing it, creating a legal obligation to pay in 90 days. They return this accepted draft to the seller. Now, let's say 60 days later, the Vietnamese bank unfortunately goes out of business. The seller is holding this accepted draft, which now seems worthless. But sub-Article 7c comes to the rescue. The seller can go directly to the German issuing bank on the maturity date, present the accepted draft and the compliant documents, and the issuing bank must pay. Here is the real protection. The issuing bank's obligation is independent and is not discharged just because its nominated agent failed. This is a powerful fallback for the beneficiary, ensuring that the ultimate promise of the LC, which comes from the issuing bank, remains intact. The same logic applies to a deferred payment undertaking. If the nominated bank promises to pay in 90 days and then can't, the issuing bank must step in and fulfill that payment obligation. But in the case sub-Article 12c does not act under its nomination, merely checks and forwards the documents, whichever the situation may be, it is not obliged to pay and its role is merely a post office. So to quickly recap the essence of Article 12, first, nomination by itself doesn't create an obligation for the nominated bank to act. They have a choice unless they are also a confirming bank. Second, if a nominated bank does act and honors or negotiates a compliant presentation, it has a right to be reimbursed by the issuing bank or the confirming bank that authorized it. And third, if a credit is available by acceptance or deferred payment, and the nominated bank that incurred this obligation is unable to pay at maturity, the issuing bank must step up and pay the beneficiary. Merely receipt or examination and forwarding of documents by a nominated bank does not make that nominated bank liable to honor or negotiate, nor does it constitute honor or negotiation unless it is a confirming bank or unless and until it fulfills its obligation by payment. Understanding Article 12 is so important because it clarifies the relationship and the flow of responsibilities between the beneficiary, the nominated bank, and the issuing bank. It defines the limits of a nominated bank's liability and secures their reimbursement, which encourages them to participate in the LC process. At the same time, it provides a critical safety net for the beneficiary, ensuring the issuing bank's promise remains the ultimate guarantee. So, next time you're looking at a letter of credit and you see a nominated bank, you'll know exactly what their role is, what their obligations are or aren't, and how the whole chain of payment and reimbursement is structured. It is these kinds of rules that create the trust and predictability that make global trade possible. I hope this detailed breakdown of UCP 600 Article 12 was helpful for you. It's a cornerstone of LC practice. If you have any questions or want to share your own experiences with nominated banks, please drop a comment below. I love hearing from you all. Don't forget to like this video if you found it valuable and subscribe for more deep dives into trade finance. Thanks for watching, and I'll see you in the next video.